Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Fed rate cuts and what we can expect on mortgage rates. Logan, welcome back to the podcast.
Wonderful to be here, Sarah. And I just want to say that there is a lovely lady who designs very beautiful shirts. She has a very talented mother. I just wanted to showcase the goods.
Oh, that's so nice. My daughter, Katie, has a clothing company called Palmyra, and Logan is modeling a shirt he bought from that. Thank you so much. That's awesome. Love
Which
seeing
means you owe me a cookie.
Okay.
And I prefer like moist chocolate chip cookie with chocolate mint ice cream on it.
Okay. I will get busy on that. Next time I see you, I will give you a cookie and some ice cream. I love it. So we have a lot to talk about today. What an exciting week. Okay, so I hope the answer is yes. Are Fed rate cuts on the table?
Okay, everybody take a deep breath. This last week had a lot of interesting data points. And as I am talking with you right now, President Fed Goolsbee, who's considered to be one of the dovish persons, is kind of like trying to talk hawkish, which is kind of funny. Obviously, 15 of the 19 Fed members that were on the dot plots had 1 to 2 rate cuts into the year. This is before the recent data. So I would have to say that rate cuts are on the table. But, as always, paper, rock, scissors. Labor data is more important than inflation. We are sitting here. It's Friday. The growth rate of CPI inflation fell from 9% all the way down to 3% or in the 3% level. PCE inflation went from 7%, has a 2 handle. This last week, a lot of the data lines that filter into the PCE data, it's going to show we're going to have another 2 handle and no rate cuts, right? And not only no rate cuts, they're like, oh, we have to watch it. We have to watch it. We need confidence. So one of the things I think it's been hard for me, and I have to utilize at least what I believe the Fed is doing, is that the Fed is scared and they need cover. And that's the honest truth, okay? These are human beings. Right? You could read human beings. You could read somebody that is willing to pull the trigger, and then you could read somebody that's going to be, I don't know. So I see a bunch of people that are, and because of that, because of the nature of a human being and a kind of almost like a rat pack mentality, all of them together, they're part of this institution. The institution cannot be criticized. The institution can be regulated, can't be regulated. I think as a whole, they feel much better when the labor market is breaking. So what is more important than the inflation data is the actual labor data has gotten to the point where it's no longer tight in their own models anymore.
Yeah. So that's one of the big takeaways from this week, right? Is that we saw that Powell actually said, and we talked about this on the last podcast, that Powell actually said something about the labor market, sort of confirming what you've been waiting to hear from them all along.
Yeah, and in this context with the Federal Reserve, I set numbers, right, target levels that I want to see before I could get confident in them before they talk, and that was 7 million job openings. It was also wage growth getting down to 3%. Those things are still going to happen, and that just reaffirms my belief that the closer we get to those things and jobless claims rise, it doesn't even matter what the Fed does. The 10-year yield, as we've seen, will head lower already. But what's different now is that we have the labor data to back it up. So I've always told people, always take the under. Right now, we look like we're going to get 2 rate cuts. Okay? Take the under until the labor market forces the Fed to do something, right? Because, like I said, they're not going to get ahead of the curve. They could have got ahead of the curve if they wanted to. They chose not to. They chose to change the language. The whole Fed is, someone spiked the eggnog. And then when jobless claims and everything starts to break, what they're going to hope for is that the 10-year yield goes down, mortgage rates go down, the spreads get better, and then the housing market picks up and it alleviates some of the weakness that you're going to see in the economy. And then they could start handling the labor data and how many rate cuts or what do they need to do. But they're not kind of going to get ahead of this with the job openings data where it was, where wage growth where it was. But now we finally have the confirmation. And remember, you take the last few Fed meetings, Powell said, "Oh, we watched jobless claims; it went lower." Bostic said, "Oh, listen, the labor market's resilient. That's why we're still restrictive." They're telling you this, and they finally said it. We're no longer tight anymore. We're pre-COVID level. And that's the quits ratios, right? The quit ratio percentage is really what they like to track, and it's pre-COVID already. It has been for some time. So rate cuts on the table, but for everybody in the real estate industry, that's not what matters. It's what the 10-year yield. And what drives the 10-year yield is perceived weakness in the economy. But the last two times, whenever the 10-year yield has fallen, shoots right back up, right? Because the labor market wasn't breaking. But now, I think you could get the two rate cuts a little bit more solidly in as long as the labor data starts to get softer, because clearly it's almost July in 2024 and there's no rate cuts with the growth rate of inflation falling. I think they're too scared to pull the trigger, but they're getting to the point where they understand. I mean, it's not like the Fed doesn't have, their whole entire life is to look at data. They're seeing the same data I am. They just can't publicly say, "Oh, we just want the labor market to break." So in this context, hopefully the last 2 years made sense. Hopefully the last week, the 10-year yield, down again a few basis points today. Import prices came in, it was negative. So the filtration of the PCE inflation data that the Fed tracks in a few weeks, it's going to show another 2 handle. But the labor data is different now. And that's where we are currently, where we weren't in 2022, where we weren't in 2023, and where we weren't in 2024 until the Fed finally gave the cue that, okay, we're not no longer a tight labor market. So rate cuts back on the menu, boys. Yeah. But we track weekly data. We track labor data. We think that's more important for the economic cycle. It's more important for the mortgage and real estate industry. As we've seen, we've had 2 different moves lower on the 10-year yield and mortgage rates with no rate cuts happening. Both times have created purchase application data to pick up, and then it's reversed, right? So can we have a cycle starting on rates where we don't get that sharp reversal, that we can actually break under 6%? And kind of hover around there for some time so people can make choices, with the affordability better right now. Because what's occurred is the growth rate of home prices have slowed down tremendously from the savagely unhealthy levels in early COVID, but it's not getting cheaper as long as rates are up. So it's one of these dynamics where Powell said, "Hey, listen, there's still going to be a housing shortage, but if we handle inflation, we can bring rates down." So I think we're in a different backdrop now than we were in 2022, than we were in 2023.
So, one of the things that you get asked a lot when you are speaking and I'm in the audience Q&A, something that almost always comes up is someone will ask about, consumer debt, credit card debt, things like that. I know that doesn't count for when you think about homeowners, but does the Fed look at that? Is that part of their calculus for like how everything's going?
It's funny you should say that, Sarah, because just before I got on here, Goolsby said, there's parts of the economy that are showing stress, and we are keeping an eye on it, but it's not at recessionary levels. And I retweeted that tweet and did the meme where Anchorman says, "I don't believe you." It's like when Neil Kashkari says, we're keeping an eye on it. We're looking at the data. We're seeing it rising. We're keeping it. Oh, you're not. You're not. If you did, you would. The terminology would be, we are noticing delinquencies happening to younger households who are renter financial profiles, and we're seeing it, but we don't care. Because if we did, we would talk about it more. We'd be like, well, we're going to find a way to maybe help this, or they're not saying anything. They're just saying we're keeping an eye on it. And they can't really say anything because remember, they need sacrificial lambs or pawns, and that's who it is. Younger households who are renter households, especially single, who started off with not that best of a financial backdrop anyway, lower prices. They're getting hit. And, and again, every single month people lose their jobs. So there's more of a risk of you have some acceleration in that. But it's something when the labor market breaks that could give them a little bit more cover, because we haven't had a job loss recession yet, and the credit lines are breaking. So we even talked about this a few months ago. It's already deteriorating. Wait till the recession hits, it'll deteriorate more. And then they're going to go, okay, we now have to be more, we have to go from restrictive policy to neutral to accommodative. Now, if you start to get job losses and credit deterioration, you're going to move from restrictive to accommodative stance fairly quickly, but we're just not there yet. So whenever a Fed president says, oh, we're keeping an eye on it, I call, BS. No, you're not. All you're doing is watching jobless claims. When jobless claims break, you're going, oh my God, we have all the confidence in the world to cut rates now. And hopefully by now that we've seen some of the disinflation happen, and even and it's interesting because there's a lot of people in the economic world who say, what is the Fed doing? They're letting these Q1 seasonality base effects ruin their talk. And that's not the way to look at it. It was always about the labor market, because that's what they're running on. They're running on old Fed models that say you have to attack wage growth in the labor market because wages growing and people working and people having sex and buying homes. Neil Kashkari, remember 6% mortgage rates. Oh, it's not good. How are we supposed to balance the market if, so look at it in that light, and it starts to make sense, right? It starts to look back like how they wanted to attack it in the late 70s, hit demand hard enough to where the labor supply gets hit, wages come down. It's really hard to get accelerated inflation when wage growth is falling. You would need some kind of supply shock. And we did that podcast. Like what would it take to have the 1970s inflation? It's really a supply shock at this point. So paper, rock, scissors, labor over inflation. So we always keep an eye, because what if jobless claims start to go down again? What if the labor data doesn't break and the Fed goes, I know inflation is cooling, but, and even to me, even if they cut 3 times this year, if they would have, they're still restrictive on their own policy based on their own model. So, but it's back on the menus, but let's be a little bit mindful that they really want to see the labor market deteriorate more before they can really, trust me, oh my God, when jobless claims are going to rise, wait till the podcasts we're going to have when that happens. We're going to take all the Fed's verbiage and go, oh my God, I found confidence. Oh my God, how did this happen? So nature of the beast.
Okay, so let's get specific on mortgage rates, right? 10-year yield is great, but we want to see what are they going to do, especially because we have a different situation this year with the spreads.
So the spreads are better year over year. It's still historically high, but again, we could be 40, 50 basis points higher today, where we are easily 7.5% instead of kind of much lower than that. So how I look at it is kind of goes back to the November 9th premise. If the bond yields fall and the forward-looking data gets better and you don't go with it, then that's on you, right? That's why we keep on harping on November 9th, that let's keep an eye on purchase application when rates are falling. And let's just do a hypothetical. Let's say the 10-year yield gets down to 3.80 and the spreads get better and we have 6.25% mortgage rates. If we have 7, 8 positive weeks, that's a material change. I personally need to see at least 12 to 14 to make it worth something valid. But the forward-looking data is getting better. It doesn't take much because we're working from really low levels of sales. And we have more inventory, right? There's more choices for people, right? So it isn't like, because I still say today, this is where people get confused. Active inventory was like near all-time lows and home sales were a lot higher. 2 million higher. on the monthly prints. So they're like, wait a second. How do we have so many home sales when there's no homes to buy? Because the no homes to buy is okay. That's what it is, right? Sellers or buyers, they put their homes on the market. They sell their homes fast. They don't even get into the inventory data because we close transactions. So you can have sales rise. Do not ever fall for the, there's no homes to buy act, especially with rates this high. When rates have gone down in late 2022 and late 2023, what happened, Sarah Wheeler? Both times we saw, oh my God, the one print was like one of the biggest month-to-month sales prints ever recorded in history. And then we had back-to-back prints that took us to about 500,000 more monthly home sales. So it's there. It just needs lower rates. So this is why I'm like trying to get people to realize when forward-looking data gets negative, it's negative. You go with it. When it gets positive, it gets positive. So we had 1 week, positive 9%. I would, very low bar, but duration matters. So rate cuts, you don't need it. We just need the 10-year yield to go down first. If you start to get 10-year yield falling, spreads better, and rate cuts, and a combo, what's going to happen, Sarah? Where we're working from low levels of sales, do you think sales are going to go? It's funny. I always get these people that go, oh, but unemployment's going to go up and nobody's going to buy homes. And this goes into the idiotic factor. We're going to have 159 million plus by the time the recession hits.
People working.
That's the highest non-farm payroll ever in the history of America by the time the recession hits. So my army's bigger than yours, right? Think about it. I'm going to have 159 million Americans armed to the teeth, and you maybe can get 1.5 to 1.7 million people lose their jobs in the first 8 to 12 months. You think you're going to go to head with my crew, right? That's been sitting there waiting for rates to fall down. You think they're going to go, well, David in Minneapolis, 6,000 miles away, lost your job. I don't think I want to buy a house. No, people will jump on it as long as they're employed. And most people are always employed in a recession. Most people, median to higher incomes, are always employed. The unemployment rates are the highest for high school dropouts. So we go into a whole new discussion, but as long as sales are this low, we have seen what the data has shown us, and we haven't even broken under 6% rates yet. But working from these low levels, that first move is going to be positive, and that's how it's worked since the Peloponnesian War, Sarah. The credit markets of 2005, deteriorating right to 2008 is much different because the credit availability index spiked up. Like the MBA has this index 1 to 900. It was like 900 in 2005 and it just collapsed. And it's gone nowhere for 13 years. It just sits there, right? Lending can't get tight or can't get too loose. It just sits there. In fact, I don't know if you remember this, but when we were doing the COVID-19 recovery model, people said, oh my God, look, lending is tight. Nobody can buy a house. I was like, what the hell are you talking about? It's like, it hasn't gone anywhere for like 13 years. And that's going to be another thing where people are going to, they're going to tight lend. It's a 30-year fix. As long as Freddie and Fannie are in conservatorship, you got a credit flowing market. If they weren't, right? Mark Calabria came back, rise from the grave. If he came and said, we're going to get Freddie and Fannie out of conservatorship, we're going to make them publicly traded companies with no government, then credit could get tight, right? Credit could get tight. And I'm telling you guys, I'm not kidding you when I say this. The people that want a housing crash, a lot of them, not all of them. There's some crazy people that just want the world to burn. But there's a lot of people who make a lot of money off of, distressed sellers, right? So that's their business model, right? So when they say, the government can't, they hate the government helping people because they can make less money. So think of all these real estate investors, all these years that have been waiting for foreclosures to happen. And then this, right? I mean, remember the whole forbearance crash bros thing was, for those that don't know, in the summer of 2020, I came up with the term forbearance crash bros, a bunch of grifters online. And one thing I said is that there's a lot of investors here that are just waiting for distress. So they want to say, hey, everyone, forbearance is going to crash the market. I'm your guy. Okay. I'll buy these homes. And so whatever it is, it pisses the hell out of them that the government comes in and helps people out. So forbearance was done by October of 2020. Anybody read the labor data? It's like, oh my God, pretty much everyone who made over $60,000 got their jobs back by October. So forbearance was already finished. And how many months did we drag that out, Sarah?
Oh, at least a
Was it
year.
like
It was
16,
amazing.
17 months? We just drag these dead carcasses every single month. And, forbearance crash bros, forbearance. They're like, oh my God, there's 1 million people. There's 600,000 left. There's 500,000. Now it's like 0.03% of Freddie and Fannie loans are in forbearance now. They're like, what happened? Reading is a good thing. And this is why I want live debates with anybody. But going out in the future, don't worry about that. Most people working, sellers or buyers, right? You can have a functioning market as long as credit is flowing. If credit isn't flowing, then that's different. If Mark Calabrio got what he wanted to take
Oh,
Freddie and
wow.
Fannie out of
Yes.
conservatorship, you could put me in the crap. I don't know if Freddie and Fannie could function if their stocks are falling, right? So there's some institutions that I don't believe should be publicly traded companies because they're too big and too important. And Freddie and Fannie has worked flawlessly that they're not publicly traded companies without government protection or government sponsorship. They are way too big and important to let them get to the private sector. Because once you get into the private sector, what is it, Sarah? What did Dan Aykroyd tell Bill Murray in Ghostbusters? It's the private sector. These people want results. You
Yeah, I was like,
don't know what
I
it's
don't know.
like out there.
There's a lot that could go in there. I was thinking trading places. I was like,
No. It was a great scene from Ghostbusters. He was telling them, you don't know the public sector is you can do whatever you want and fail, but the private, man, God, they want results. So that's why I'm a little bit mindful if they ever got out of conservatorship. But now credit's flowing, right? And we'll take it one week at a time. And remember, we're all in this together. We do the tracker to keep everyone informed because we don't want to be cold and slow. We want to let everyone know what's going on. If it's negative, it's negative. If it's positive, it's positive. But whatever it is, for the first time, all of you get to see it fresh. You don't have to wait for the existing home sales report or anything like that. Too slow, right? And we get to see the dynamics. That's why we highlight November 9th. The forward-looking data got, the funny part was like, by the time June of 2023 came and people were anticipating like 10, 15, 20% home price, we still had people in the mid part of the year that kept on saying, prices follow volume. Here it is. I was like, dude, you're like 8 months behind the curve. No, that's not how it works. Like forward-looking data got better already. They're like, oh, I don't know what you're talking about. Clearly you don't. You don't even have the data, do you? It's like, no. Yeah. Let us do our job. This is what we do best, right? So we just want to keep the data simple and fresh and keep everyone updated. But again, home prices didn't crash nationally for a reason, right? Our job is to explain it to you. So the 10-year yield, everything revolves around the 10-year yield on housing. So we have to keep an eye on that, and it's come down noticeably in the last few weeks. But we could talk about rate cuts, but again, the labor data to me matters more to the mortgage and real estate industry than people think. Forget about the Fed's going to be old. Look how old and slow the Fed is. It's like they've already had their disinflation, and they're like, we're keeping an eye on things. We're like,
and I would say that, in the tracker, we now have that new pendings data, which is so great. Another forward-looking data line that we can let people know about and really tells you what's coming next. And
yeah, it's the pending contracts will keep people versed. It's one of these things where, it's really hard to break under 4 million, home sales. But if you have more new listings, you have more sellers than buyers. Now the pending contract is slightly up. But again, if the rate story is changing a little bit and the forward-looking data gets better, remember, it's going to take some time before it hits the sales, but we'll be able to catch it on the pending contract. This is why we wanted to add that to the tracker article. So again, be fresh, be new, get all the data ahead of everyone else, and then take it from there. And knowledge is power, right? Knowledge is power. A lot of people that you're listening to not only do the people don't have the data, a lot of people one thing is I've noticed, a lot of people take Redfin's and Realtor.com's data and they don't know how to explain it right, which I'm sure their data scientists are laughing in the background, but it's just like, oh, no, that's not how it works. I was like, okay, whatever.
okay, well, just a note, a cultural note there. Ghostbusters came out 40 years ago this year, right? I think they
Oh
just had this
yeah, in
whole thing.
1984. I remember Santa Monica, Westwood. That's where people used to watch all the movies, and I remember going to Ghostbusters. I thought it was great.
Oh, I
And
thought
then
it was
Gremlins was out that year too, and I was like, oh my god, Gremlins and Ghostbusters! Like I think a 9-year-old kid. I was in heaven, you know. So good
well,
times back then.
that's the year I graduated from high school, so I have my 40th reunion this year. Can
You
you
could have
believe
been
that?
my babysitter, right?
I could have, yes. I'm that much older than you. Yes, I could have. Oh my gosh. So anyway, shout out to Ghostbusters. It still holds up. Hilarious. And Logan, thanks for being on today, kind of giving us the insight. This is something we know our listeners are so interested in, is like what is happening with mortgage rates, and not just like, okay, when is the Fed going to do something, but what is going to happen naturally with the 10-year yield and the spread. So I appreciate it.
And it's going to be more and more interesting the next few Fed meetings, especially if the labor market is breaking, because verbiage, like these bond traders are just like waiting for one or two key words just to start buying the 10-year yield. So if the labor market is deteriorating, then the Fed can't, use that as their cover. They've used it all for the cover for the last 2 years, but it's slowly starting to evaporate from them. So Fed rate cuts are on the table again. We've got one or two, but that's somewhat irrelevant. The whole economic data matters more. And we've just had this move lower because it's not just the inflation data got better, but some of the key labor data that the Fed is talking about is getting softer right in front of them. And they just finally acknowledged it. So again, different stages. This is not 2022. I don't have to create the Gandalf line, right? We're not doing that battle anymore, but one step at a time, 1 week at a time, data 24/7. I eat data for breakfast, lunch, and dinner, and 2 o'clock in the morning. So I'm there.
It's true. You do. And we know what you're going to be doing tonight. Friday night, you're going to be looking at all the data for the tracker. So, Logan, thanks for doing all that work for us and for being on.
Pleasure as always, Sarah. And love the
Yeah,
shirt.
it's an amazing shirt. Yes, Palmyra. It's a great clothing line that my daughter does. So nice of you to show that off. All right. Thank you so much. We'll see you soon.